Hello again. I wanted to talk to you about what the key things are, key factors to look at during the next few days or even weeks. And this is loosely based on something from Christina Huber. She's a chief global market strategist at Invesco. I like the way she organized it. So I'm just going to tell you a few key ones she gave and some of the ones that I'm giving. Number one, Europe's response to a natural gas cutoff. We all know what's going on with Putin and Russia. They're playing mind games. But basically, Putin's squeezing a wrench and he's just going to make life tougher for Europe. Now, right now, Europe's doing a good job at storing gas. But there's going to be a point in the winter when they need gas and it's going to be very expensive. Of course, I'm talking about natural gas. Now, of course, they can get LNG from the United States, but number one, you got to export it. And number two, you can't just buy LNG from the United States. First of all, another thing, it's expensive. And second of all, you need liquefaction facilities, and there just simply aren't enough right now. The second point to make is the European Central Bank meeting. Now, I think Europe's in a rock in a tight spot. Here's why, or something like that. The thing is, Europe has, and I'm including UK here, has record high inflation. But here's the problem. They need to raise rates. But if you look at the southern European economies, it's always the southern economies, isn't it, right? Italy, Greece, you name it. It's always these countries that have problems. Why? Because they never solve their problems in the first place. And Europe just keeps kicking the ball. So the problem there is the ECB meeting. They need to raise rates, but they also need to take care of those southern economies. So what are they going to do? I don't know. They want to do something fancy where they're keeping rates low for the southern economies, but then high for the rest of the economies. I don't know how that's going to work. And anyway, the problem is the northern economies like France and Germany, which are very strong, historically are no longer strong. Because remember, Germany exports a lot to Asia, specifically China, and they're seeing a drop in orders. And anyway, they can't even keep their factories running because natural gas and energy feedstock costs are too high. So let's go to the third point. So that's a dilemma. We don't know what's going to happen. Three, what's going to happen with the new UK Prime Minister, Liz Truss? We don't know what her plan is for the sterling and for her fiscal and monetary policy, mostly fiscal policy because she can't control monetary policy. Number four, and this is something that's been lagging, is China. What are they going to do to restore their economy? They're caught in a tight place too. Why? Because their reserves are down to $3 trillion. And they don't even want them in US dollars, right? They want to start trading and on yuan, like if that's going to help them. But the problem is they need to spend more. And they lowered rates, but like so little, like by a drop, that's going to mean nothing for the economy. And as you know, the residential economy, I should say the building economy, real estate is crashing. So either they should let them crash and have them restored, but that's not a capitalistic way of doing things. Not even in the United States that we're doing that anymore, right? We're not supporting companies going to bankruptcy. We remember what happened back in 2020 during COVID. The Fed, and I would say illegally, the Fed illegally supported non-investment grade companies. So if the Fed's doing that here in the United States, imagine what China's doing. They're not going to be letting companies go bankrupt and restore themselves. So what's going to happen with China's stimulus? That's the question. I don't know. But I do know China needs to stimulate more. One way of stimulating, and this is going to lead to the next point, is by lowering the yen, letting their currency decline. So here, this goes to my fifth point. The yen. The Japanese yen has fallen below 140 per dollar. I think they're 143. And here's the thing. First of all, let's go back to that. If they're around 143 to the dollar, that would be a 24-year low. That's even lower than what we're seeing with the euro versus the dollar. The euro being below parity is at a 20-year low. So the Japanese yen is at a 24-year low. But you don't hear anyone in the United States government talking about currency manipulation. Here's why. I think the US government, specifically the US Treasury under Janet Yellen, has made an agreement to allow the Japanese yen to weaken. It has a two-pronged approach. Number one, it helps their exports, helps support their economy. Of course, it imports inflation, but they don't have to worry about inflation because of their weak demographics. And number two, why is the US encouraging this and not accusing Japan of being a currency manipulator? Because if the Japanese lower their yen, the Chinese are going to have to lower their yuan. And I think that's behind all this. So let's see what happens with the Japanese yen going forward. Number 6, the Bank of Canada. They made a decision this week to increase rates by 75 basis points. Some people were looking for 100 basis points. The Canadian economy is quite strong. They don't need to worry as much as the Europeans and the UK about raising rates. Because remember, the Canadian economy is a natural resources based one. That means they're naturally hedged against higher inflation. For example, Canada has oil sands, right? So price of oil goes up, they're fine with that. And they have fertilizer. They have lots of potash, for example. And they've got, what else? They have gas, and they have forestry and lumber. So Canada is in pretty good shape. But it's important to know what the Bank of Canada does, because what Bank of Canada does affects our treasury market. Copper prices. Finally, Dr. Copper is going to be a leading indicator, a canary in a coal mine of what the global economy is doing. Because think about it, China and other parts of the world that are rapidly growing depend on copper for their infrastructure. So I think I named most, and maybe I had one or two. Number 8, what's going to happen with the Fed's beige book this week, and what's going to happen with the ISM index. I know I talk about the ISM index over and over because it's very important. And if you look at Raoul Pal, he's more obsessed about the Purchasing Managers Index than I am, because he knows, as I do, that the PMI is the canary in a coal mine. It's not even copper. It's the PMI index, because the PMI index is at home here. It tells you what the U.S. economy is doing. So I think I covered everything. I didn't talk about interest rates, but I think we all know that Jerome Powell is going to be increasing the Fed funds rate by about 75 basis points at its next FOMC meeting. So that's all for today. I gave you, 8 or 9 indicators to look at of where the global and U.S. economy is going. And I hope you find this helpful. And I'll see you later. Take care. Thank you. Bye-bye.